Today we're gonna analyze Xiaomi. It's a Chinese technology company worldwide known for making affordable yet high quality electronic devices. They sell smartphones, smart home devices, TVs, electric scooters, and also recently entered the electric vehicle market. So if we take a look at the stock price, we can see we are up around 340% in this 1 year. So this is incredible, and we're going to take a look at the financials to find out if this company is still a buyer right now. The first thing we can recognize is a market cap of 177 billion US dollar. So it's already a huge company, but still compared to Samsung with 246 billion US dollar and Apple with 3,524 billion US dollar is still a lot of potential if this company can continue to grow in the future. So the first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2019, the revenue was around 205 billion Chinese yuan. This was a 17% growth. Then in 2020, we had around 20% growth. Then in 2021, we had a strong growth with 33%. And then in 2022, we had a 14% decline. And then again in 2023, around 3% decline. So finally, now in 2024, we had a strong increase again, around 25%. So overall, we are up. We had a strong revenue growth in the last 5 years. So there's a check here. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we want to see that grow. In 2019, the free cash flow was around 20 billion yuan. Then we had a 7% decrease in 2020. Then in 2021, around 86% decrease. Then in 2022, we had a negative free cash flow around 10 billion yuan. And then in 2023, we had a strong free cash flow around 35 billion yuan. And then in 2024, we will have around 17 billion yuan. So overall, it's very inconsistent. We had some growth and then some decline again. So overall, it's not a check here. We can also see about the operating cash flow. I think this company investing a lot of their money in the business because it's still a growing company. So the main reason for the declining free cash flow is that this company is investing heavily into the future. They're investing in the electric vehicle business, the AI business, and also the smart device business. So in the future, this investment could mean a higher free cash flow. So what I also find interesting is we see the free cash flow margin is declining, especially now in 2024, it's around 5%. But what is also interesting is that the EBITDA margin is increasing over the time. So this can mean that the core business getting more profitable. So this is a good sign, I would say. So the next thing we're looking for is free cash flow yield over 4%. This can show how much is the valuation of this company. So if it's under 4%, it can mean the company is overvalued. So what we're going to do is we're going to take the free cash flow around 17 billion yuan. Then we're going to divide it with the current market cap around 1,283 billion yuan. And then we're going to get the free cash flow yield. So the free cash flow yield is around 1.3%. So it's very low, but we also have to consider this company is investing heavily into the future. So I think we should make some assumption right now because the free cash flow margin is around 5% and this company is investing heavily into the future. We can also see here in 2023, the free cash flow margin was around 13% and also in 2019, close to 10%. So overall, I think we can assume that this company can have a free cash flow margin around 11% in the future. So if we're gonna calculate then the free cash flow, we're gonna take the revenue around 330 billion and then the 11% free cash flow margin. This would make a free cash flow around 36 billion yuan. Then we're gonna calculate the free cash flow yield. This would be around 2.8%. So overall, also if we assume that this company can have the higher free cash flow margin, it's still not over 4%. So this company looks overvalued right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. Very important number, because if a company has too much debt, it can risk to go bankrupt. So we don't want to see that. And we can see here the long-term debt was around 22 billion. Then we're going to add the short-term debt as well, around 5 billion yuan. Going to divide it with the free cash flow around 36. This is with the 11% free cash flow margin. And then we're going to get the number around 0.75, which means a little bit under 1 year, we can pay back the debt with the free cash flow. So it's a check here. The next thing we can take a look is the cash on hand this company has. So this is around 100 billion yuan. This is a great number as well. They can use this to invest in the business or to pay back the debt. So the next thing we're looking for is the enterprise value to free cash flow ratio under 25. So this can also tell us about the valuation of this company. So what we're going to do now is we're going to get the enterprise value. So this is the current market cap, around 1083. Then we're gonna add the debt that we have around 27, and then we're gonna take off the cash on hand, so around 100 billion. So the number we get is around 1210. So this we're gonna divide with the free cash flow around 36. So the number we get is around 33. So this is over 25. So it does look overvalued also of the enterprise to free cash flow ratio. So this company right now looks overpriced to me. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. This is something we like to see, especially we think the company is undervalued. So what we're going to see here is we can see the shares outstanding did increase many years in a row. This means the company tries to get the money from the stock market to invest in the business. But we can also see in 2022, the shares outstanding did decrease, and also in 2024 it decreased around 0.5%. So this is not a big amount. So overall the shares outstanding did increase in the last 5 years. So I think it's not something bad necessary, because it's still a young company and they need the money to invest in the business. I would like to give my conclusion about this company. So let's start with the positive. So they had the revenue growth in the last 5 years. They have the EBITDA margin increasing, which can show that this company is getting more profitable. They also have a lot of popular products, especially their phones, and nowadays also their electric vehicle. What we don't like to see is a free cash flow decline, and also I think this company has a high valuation. If we consider the enterprise value to free cash flow ratio is around 33, and this is also if we consider that this company could have a free cash flow margin around 11%. So overall, this company looks expensive right now, and the stock price increased around 340% in the 1 year chart. So overall, I think this company is very hyped right now. So especially now with the electric vehicle business, this company can still grow in the future. Personally, I think the financials is looking overvalued right now, but if the company can grow the electric vehicle business even more in the future, I think there's some opportunity that this company can have the better financials soon.